I'm joined live from Hong Kong by Kirby Daley, Senior Strategist at Newedge Group. Kirby, good morning. Thanks very much for joining us.
Good to be here, Mark. Thank you very much.
Kirby, I mean, you say that equity markets remain overvalued. What's your thinking behind that?
Well, basically, earnings projections are too high based on economic fundamentals. We've seen the risks in the global economy reflected far more in fixed income markets. They're pricing a far more dire scenario than equity markets, but we often see this. Analysts revise down expectations, earnings expectations. Companies revise them down as well going into these periods. So it's nothing that's surprising. It's just that equity markets have been sort of trading in their own world over the summer, bolstered by great earnings, but we have to look at how we got those earnings, mostly through cuts. We need top-line growth for earnings to continue. The idea that top-line growth is going to be strong in the economic environment that's coming is a bit far-fetched as far as I'm concerned.
I know you remain extremely negative on Japan. We had those weaker-than-forecast GDP numbers yesterday. What's so bad in your eyes about the Japanese story?
I wish I could take the converse of that and tell you something that's good about the Japanese story. Having spent 12 years there, I speak the language, I love the country, I have nothing against it. I hope that it can persevere. The problem is it has some incredible headwinds against it in the medium and long term. Short term, obviously, the strong yen and the overdependence on exports, but longer term, the idea that Japan can turn around its fiscal situation with the demographics working against it, as well as global aggregate demand dropping to a point where Japanese products are not going to be as in demand as they have been, and the fact that because of the fiscal situation ever worsening, the idea that domestic consumption will pick up is, again, a bit of a fairy tale, because Japanese know that higher taxes and lower benefits and services are coming in the future, therefore they continue to save. They're in a situation that's sort of self-enforcing, and it's going in the wrong direction.
So, Kirby, where do we put our money right now? As you say, equity markets remain overvalued. The outlook for the global economy isn't exactly optimistic. So where should one put their money?
Well, putting your money in a long-term investment right now and simply buying an asset is a bit difficult. Trading is a better way to put it, because asset prices are going to be moving in flux as we move back into a more risk-averse scenario. And that means we're likely to see the dollar strengthen in the coming months as risk aversion seeps back in. So getting back into the U.S. dollar after this bout of weakness is not a bad idea. Fixed income is already quite expensive. We're looking at record low yields in U.S. Treasuries, Japanese 10-year bonds yielding under 1%. There's probably not a lot of upside in buying those bonds at this point, but certainly wouldn't sell them. And I would just lower my, if you have exposure to equities, I would look at lowering that in this period.
Kirby, thanks for joining us.